Dollar cost averaging is an investment strategy that aims to reduce the impact of volatility on purchasing an asset. Now, it involves buying equal amounts of the asset at regular intervals. The premise is that by entering the market like this, the investment may not be as subject to the volatility as if it were a lump sum or a single payment. Now, how so? Well, buying at a regular interval can smooth out the average price, your average entry price. In the long term, such a strategy reduces the negative impact that a bad entry may have over your investment. Let's talk a little bit about how DCA works and how and why you might want to consider using it. Now, why dollar cost averaging? Well, the main benefit of dollar cost averaging, or DCA, is that it reduces the risk of making a bet at the wrong time. Market timing is among the hardest things to do when it comes to trading and investing. Often, even if the direction of a trade idea is correct, the timing might be off, which makes the entire trade incorrect. DCA helps mitigate this risk. If you divide your investment up into smaller chunks, you'll likely have better results than if you were investing the same amount of money in one large chunk. Making a purchase that's poorly timed is surprisingly easy, and it can lead to a less than ideal result. Now, what's more, you can eliminate some biases from your decision making using DCA, and once you commit to using this as a strategy, it will make the decisions for you. Now, dollar cost averaging, of course, doesn't completely mitigate risk. The idea is only to smooth the entry into the market so that the risk of bad timing is minimized. Now, DCA absolutely won't guarantee a successful investment, and other factors must be taken into consideration as well. Now, as we've discussed so far through Chapter 1, timing the market is extremely difficult. Even the biggest trading veterans struggle to accurately read the market at times. As such, if you have dollar cost averaged into a position, you might also need to consider your exit plan. That is, a trading strategy for getting out of your position. Now, if you've determined a target price or price range, that this can be fairly straightforward. You, again, divide up your investment into equal chunks and start selling them once the market is closing in on the target. This way, you can mitigate the risk of not getting out of your position at the wrong time.
Dollar cost averaging is a more conservative approach to investing than simply spending all your money on securities at once. This technique allows investors to commit to a fixed dollar amount of a particular investment on a regular schedule, regardless of the share price. More shares will be bought when prices are lower, and fewer shares will be bought when prices are higher, resulting in a lower average cost per share. Dollar cost averaging reduces risks by allowing investors to ease into the market over time. For example, Chris buys $200 worth of stock in Billy Bob's restaurants each month for 4 months. In January, the value of the shares drops to $50 each, so he buys 4. In February, the stock is worth $40, so Chris buys 5. In March and April, he buys 8 shares of Billy Bob's, which dropped in price to $25. Overall, Chris purchased 25 shares at an average price of $32. If he had invested all of his money at the same time, then he would have only bought 16 for an average price of $50 per share.